dead sideways at 4,000, let's say, and silver went to 2%, you do the math. Okay, $80. If silver goes to its norm, gold goes to its normal eightfold bull trend, and let's say it goes to 8,000, which it's done twice before, remember, in terms of ratio. What's 2% of 8,000? Okay. Silver is also well below its 2011 high. The miners just took out their 2011 high. GDX, XAU. Gold's way above its 2011 high. And even a bloody base metal, copper, is currently trading above its 2011 price high.
Michael Oliver, well known for his work on momentum and structural analysis, has been drawing increasing attention with his projections for precious metals. According to his research, the current market conditions are laying the groundwork for a dramatic revaluation of gold and silver. He argues that the shifts underway are not short-term fluctuations, but part of a structural transformation in how investors, institutions, and even governments approach real assets in the face of growing economic instability. For Oliver, the case is not just about price targets. It is about recognizing the breaking point in confidence surrounding fiat currencies and central bank policy. Gold, in Oliver's view, is the most visible beneficiary of this turning tide. The metal's steady climb through key technical barriers signals more than just investor speculation. It represents a broad move into safety as the dollar's reliability continues to erode. He points to the $8,000 level as a realistic long-term destination for gold, a price that reflects not only monetary demand, but also the scale of capital likely to exit traditional assets. Oliver emphasizes that such a number may sound extreme, but when placed against the backdrop of central banks' balance sheets, ballooning sovereign debt, and negative real yields, it is a rational outcome of structural pressures building beneath the surface. Silver, often called gold's shadow, is also primed for a major breakout. According to Oliver, the metal has repeatedly tested long-term resistance levels, and its behavior suggests it is preparing for a decisive move higher. With a target of $50 per ounce, silver would be revisiting historic highs, but Oliver maintains that this would only be the beginning of its revaluation. The dual role of silver, as both a monetary asset and an industrial necessity, gives it unique leverage in the current environment. As demand accelerates from both investors and industries tied to renewable energy and technology, the conditions for a sustained bull market are rapidly falling into place. Now, we present the clips from Michael's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you and enjoy the video.
And from various bank reports that I've read or heard about of analyzing their customers that are invested in the market and have an account in the bank that does that, the use of leverage has never been higher than it is now. And yet it's persisting. Okay, so you can make an error, but keep making it, and the longer you make it, the worse the consequence, probably. But again, the issue is when. Okay, yeah, it's a reality; those are objective facts. But again, when, and that's what we're focused on. And I do think it's a key factor right now because when it does crack, we know what's going to happen to the central bank. They're going to go berserk, even more so than they already are. Which case they'll lower rates, but they'll also increase money supply, et cetera, et cetera. But and that will impact other markets as well, because when they push the throttle, especially gold and the monetary metals will accelerate even further. Not that they're dependent on it, because they've already anticipated that event. Money's already started to flow, not particularly American money, by the way, but other parts of the world have gone into the monetary metals. Wait till that starts. I think it's already begun, and I think that's why you've seen gold miners go vertical, especially since April. Remember, gold made a high in April when we interviewed last time. Gold was up to, I think, 3,400, and it went dead sideways for 5 full months. They sold it, and they sold it, thought, oh, this is the top, this is the top. It wasn't at the top. It was just a sleepy range. What happened since then? Miners exploded while gold went sideways. Silver went from mid-30s, lower 33, 34 area, for a year. In fact, in last May of 2024, it was up to 32.70. So you could draw a line across that high through the next year of action, and you did this on either side of it. And it wasn't until late June, July, you finally went through the highs. So July, August, Sep, boom, silver goes from mid-30s to what? 43. Okay? So while gold stood still. Now gold's starting to reassert itself here. But I think that money flow that went into gold miners was from asset managers, largely the larger ones, especially Newmont, which has gone vertical for the last few months, who've decided, hey, they know the stuff you just mentioned. Too many points of excess. I think I'll move 2-3% into the gold miners. They look undervalued. Gold's been doing good. No, I'm not a gold bug, but I'm going to move some money over there. Well, when they do, it's wet bar of soap time. Squirt on the upside because it's such a small sector. And I think that probably some of the power that's driven that is the doubtful asset managers in the stock market. Can't prove it. Now, if you look at a monthly price chart, just a regular arithmetic scale price chart, and I'll go back to 2011 high, and you had the drop into 2015, 50% drop. And from 2015, you worked your way up, but it was an arm wrestling process. In fact, there was 120% correction in there between the early 22 high and it was August 22 low. You went from 2000 down to 1613. Okay, pretty nice drop, 20%. And then you reasserted yourself, but it was an ongoing, arduous process. And only now has it started to look like it's accelerating. And so if you looked at a bar chart of weekly or monthly gold, and you're an average investor, you say, boy, that's been glorious. I'm glad I was in that. And you're thinking, God, it can't go forever like this. But when you look at a ratio scaled chart, in other words, percent gain of a bull market, and go back 50 years when the government approved it for us to trade, God bless them. You've had two bull markets. There were 8-fold moves from bear low to bull high, different duration of time. One was from 76 low to 1980. The other was from 2001 low to 2011. But they were both 8-fold multiple gains for gold. We bottomed at 1,045 in December 2015. If we get 8-fold, it just did what we did twice before for reasons that were far less dynamic and significant to the world fundamentally than what we've got now. You'd be at $8,400 or so just to match what had occurred before. So when you look at the current price chart, you think, oh my God, look how ballistic it is. When you put it on a logarithmic scale chart as we're showing, it's just getting started, guys. We're not even halfway up to the gains we saw in those two bull markets. We're not even 4-fold yet. Okay, so that's something to consider. I don't trade off of it. Maybe we're not going to go 8-fold again, but considering the dynamics that are out there in other markets, either way, upside or downside, it would be easy to see gold at least matching what it did then. So don't think gold's overpriced.
Sorry, Michael, I didn't hear that. So gold's currently at 3,600, 3,700 bucks.
3,700, yeah. It's a triple, from its low,
A triple from its low. So what would that be?
Well, the bear low in 2015, which is $1,045, so $1,050, let's say. So you've tripled it. Fine, that's great, a little more. But you're nowhere even half what those were. Those were 8-fold moves. And a lot of that move occurred in the last year or so of the move. In fact, that was the case in both cases. Most of the move occurred late in the bull trend. So, and again, duration was different. One was a 3.5-year bull, one was a 10-year bull. So, maybe this one's already a 10-year. But I think the dynamics are such that what you're going to see over the next handful of months, especially over the next year, in terms of monetary metal upside, is going to be awesome and far different from the tone we've seen over the last 10 years in gold, for example. Well, they're late, but on the other hand, it's a reality. Do I get in or not? I suggest yes. Our preference, well, especially when you look at gold miners. Gold miners, we don't have any charts on this, but relative to gold, the valuation of, for example, the XAU index, which has been around since the 1980s. The 1980s, 90s, and into 2000, like up until about 2007 or 8, it was trading at either side of about 25% of the price of gold. In other words, divide XAU price into gold, it was about 25% of the price of an ounce of gold. It would oscillate above and below there. In fact, the low end of that multi-decade range was about 17.5%. So let's remember that. In fact, when you see the spread chart, if you have one, we publish it routinely. Let's call that resistance now. In other words, if you ever get back up there, you bump your head on it. Okay, where is gold right now? It's like pushing up toward, it's a 7.6, 7.7%, I think, right now, XAU divided into an ounce of gold. So you could double and a half the miners right now on a relative price basis just to get to the underside of the prior multi-decade valuation that they used to have. So they're a vastly underpriced category of the monetary metals. And I think somebody's woken up and said, hey, this is cheap, low risk, I'm in. And that's why you've seen them get goosed. But even getting goosed to where they are, for example, GDX or XAU, just recently, the last few weeks, have taken out the 2011 price high. Gold did that, when it took out 1920. So they're just catching up.
Yeah. So even though a name like Newmont's up over 100% on the year, Kinross is up 140%, Agnico's up 100%.
Yeah.
You still think there's a lot more room to go?
Oh, no, I think they've just begun, because all they've done is they suddenly come back to where gold was at about $2,000, back in 2020. Gold's now 3,700. Well, they're just getting up to the 2,000 level. And in fact, taking out the $1,920 high we had in 2011 on gold. GDX just took out that high. XAU just took out that high. So in effect, it's saying, I'm back. Okay. And it's still cheap. Because, if you take 2011 to the present, 14, 15 years or so, and you say, what's the real value of the currency unit we're using? Real spending value, it's decreased markedly because the money supply doubles almost every decade. Well, heck, just to match the 2011 high, you could probably double the current price of the miners and they'd still be where they were in real value terms versus 2011. And that puts us on the issue of silver, of course.
Yeah, and to your point, many of them haven't taken out their 2011 highs, so Agnico, I believe, might be the only name.
Well, many of them have. Most of the silver miners are still way behind, but they're accelerating. Like SIL, the ETF of the silver miners, is at a point of breakout versus GDX. Meaning, which do I buy, the gold miners, GDX, or SIL, the silver miners? I would suggest silver miners because there's more slingshot effect there, likely, meaning further percent gain than GDX will produce over the coming year or so.
So
Miichael Oliver places strong emphasis on the psychological impact of precious metals reaching such dramatic price levels. Gold trading near $8,000 and silver surging toward $50 would not simply be technical milestones, but transformative events in global finance. These thresholds would serve as a public confirmation that fiat currencies are steadily losing credibility, prompting investors, institutions, and even governments to rethink how value is preserved. The effect would likely trigger a self-reinforcing cycle. As confidence in paper money erodes, demand for hard assets grows, and as demand rises, higher prices further validate the shift away from fiat. What gives Oliver's outlook further weight is his argument that this is not a story of speculation, but a structural necessity. Mounting debt levels, unprecedented money creation, and geopolitical realignments are combining to create cracks in the global financial order that can no longer be hidden. At the same time, his momentum analysis points to stress levels in the charts where capital rotation becomes inevitable. The alignment between deteriorating fundamentals and technical signals, in his view, provides a roadmap that explains why explosive moves in gold and silver are not just possible, but probable.
Shows is pick the monthly close each year that was the highest close of the price of silver relative to gold. And we calculate that by simply dividing an ounce of silver into an ounce of gold, express it as a percent. So you see the scale on the left goes from 0 up to 7 or 8 or whatever. And you see these bars, the highest reading you had each year. The lower horizontal line on that grid chart comes through at 2%. 21 of the past 50 years have reached 2%. Right now, we're about 1.16%. Okay. We're very suppressed, very depressed relative to that norm. Okay. And in bull trends, when silver gets going relative to gold, like 79 to 80, 2010, 2011, the spread got up to 3.5%. And back in the 1980, got up to 6% plus. Okay. So just getting to a routine, been there before 21 times in the last 50 years, many of those years not even bull trends, I'd go to 2%. Well, that's nearly a double of the current valuation of silver to gold. What usually happens is when that spread breaks out, and you can't measure it that well on that graph we're looking at, but when we take it down to week action or monthly close to monthly close, and we do an oscillator, a momentum study of the spread, not just looking at the spread, we can see a breakout level not far above where we are right now that says we're going to gush. We're headed sharply toward it. In fact, since April, the silver gold spread has shot up pretty nicely. Silver is up much more in the year than gold is, by the way. Okay, so it's catching up. But there's a breakout level on that spread that says I'm going to launch, and we define the number in our weekend reports. Once you trigger that, you're going to gush up at least to that 2% level. Probably even further, but let's just say we go to the norm, 2%. Again, that's nearly a double from where you are now. Well, if gold made a high at 115 back in 2022, it was still low compared to decades ago. Okay. It dropped sharply into 2023 down to 100 area and went into a dead range 2023, 2024, and early 2025, 100 to about 108. They had one spike up to 110, but basically most of the action was in about a 7 to 8% range for 2 years, which is very dull, almost non-eventful. A lot of other markets were making big moves. It wasn't. It was not a factor. When it turned down from early highs this year and got down to 104 again, actually 104.21 was the close of March, we turned major bearish. Price-wise, you're only in the middle of the prior 2 years range, but momentum said you're gone. So momentum broke. Price didn't yet. Annual momentum of the dollar broke trends that went back 10 years, sometimes more, went to the 10-year average momentum of the dollar, which is even a longer-term yardstick to measure momentum. Even longer back, it broke a beautiful uptrend line that you could see on momentum, you cannot see it on price. On a price chart, what's been going on since that drop from March to April, once we made a low in April, by the way, which was coincident with the stock market low, dollar dropped sharply with the stock market. The dollar tried to bounce with the stock market, and it went into an up-down range from the low of April, below that level and above that level, 4 or 5 point swings. And every rally, everybody said, oh, the dollar's looking good. There was an uptrend line on a price chart of the dollar that goes back a decade that any idiot with a crayon could draw, and they did. And they've been buying it since the April low along that uptrend. Momentum says it's not going to hold. We're back now. This week, we've traded back under 97 this month, back down to the lows of the move again. Now, I don't think you're going to hold this time. And when the price guys finally realize, oh, my trend line's not holding, let's say you close a month out at 96.50 or 96, just a little below where you are now. They're going to realize, oh, we made a mistake. That line didn't hold. Well, momentum already says it's not going to hold. We think you could go down into the 70s again, if not make a new low, below the low of a decade and a half ago, which would create turbulence in other asset categories. Like you've said, we've dropped, we've been bearish since 104, so you've dropped a pretty good number of points, but it's really not that earth-shaking. The next 20 points could be earth-shaking in terms of wave effects. And that's when it'll start to impact other markets that up to now haven't been impacted severely by the dollar's movement. And again, this isn't real dollar value. This is dollar value versus other pieces of paper. Yen, the euro primarily, and the yen, they constitute 70% of the dollar.
The implication of such a shift extends far beyond investor portfolios. If gold were to reach $8,000 and silver $50, it would not merely represent a windfall for those holding metals. It would signal a dramatic repricing of risk across the entire financial landscape. Sovereign debt markets could face destabilization as bondholders demand higher yields to compensate for currency debasement. Stock markets, long buoyed by cheap liquidity, might confront volatility as capital seeks refuge in tangible value. At the same time, nations with significant gold reserves could see their geopolitical leverage increase, reshaping the balance of power in ways that favor resource-backed stability over paper promises. In this scenario, gold and silver prices are not just financial markers. They become symbols of a larger turning point. The move to these levels would validate the fears of those who have long warned about the fragility of fiat systems, while simultaneously forcing skeptics to acknowledge that something irreversible has changed. It would represent the market's collective judgment that the existing system can no longer contain the forces it has unleashed. For Oliver, this is why $8,000 gold and $50 silver are not outlandish projections. They are milestones in a historical realignment, where confidence shifts away from managed currencies and returns to assets grounded in scarcity, permanence, and trust. If you found this analysis valuable, don't forget to hit the like button, subscribe to the channel, and share your thoughts in the comments below. Your engagement helps bring these critical discussions to more people who need to hear them.